So if I told you that an international energy titan just dropped $22 billion for a natural gas producer, you'd probably assume, that they really, really wanted the natural gas.
Right. Yeah, that would be the logical leap.
But what if I told you that for the company they just bought, the gas itself is essentially a free byproduct?
I mean, it completely flips the standard logic of corporate acquisitions.
Yeah.
You usually look for potential or maybe undervalued assets. But here, we are seeing a buyer pay an absolute premium for a company where the underlying economics are already operating at the absolute limit of efficiency.
Yeah, it's wild. Welcome to today's deep dive, tailored specifically for your curiosity about the major shifts that are just completely reshaping the global energy landscape right now.
And we have a lot to get through today.
We really do. We have a huge stack of your sources in front of us. We've got press releases, investor presentations, financial statements, all dated today, actually April 29th, 2026.
Fresh off the press.
Exactly, because the breaking news from just 2 days ago is, well, it's an industry earthquake. Shell announced a colossal $22 billion acquisition of the Canadian producer ARC Resources.
Which is just a staggering number. I mean, it represents this massive structural shift in how super majors are viewing the North American energy sector. They aren't bargain hunting anymore.
Right, they want the premium stuff.
Exactly. They are buying fortresses.
And the mission for our deep dive today is to figure out exactly why Shell is paying a 27% premium for this specific fortress. Like, what is the secret sauce of ARC Resources that made them such an irresistible target?
There's definitely a secret sauce.
Yeah, so we are going to explore their specific geological advantages, their incredibly wide infrastructure moat, and the highly strategic timing of this blockbuster deal. So, okay, let's unpack this $22 billion.
It's a lot of money.
It's a huge deal, whether you are tracking global markets or just trying to, wrap your head around where capital is flowing right now. This is a deal you absolutely need to understand.
What's fascinating here is that this isn't just a big company buying a smaller company to pad out their reserves.
Right.
Shell is buying this highly specific, finely tuned system that plugs directly into their broader global strategy. They aren't just buying barrels in the ground. They're buying an optimization engine.
So let's start with the architecture of the deal itself, just to understand the immediate impact. Shell is acquiring all of ARC's common shares for $32.80 per share.
Yep.
And that represents a 27% premium over the April 24 closing price on the Toronto Stock Exchange. But the payment structure is what really caught my eye here.
The equity split, right?
Yeah, it's structured as 75% Shell shares and 25% cash. If Shell is this global behemoth, why not just buy them out in cash and take total control?
Well, because that 75% equity structure is highly intentional.
Mm-hmm.
By offering their own stock, Shell is essentially telling ARC shareholders, we don't want you to just take a check and go home.
Oh, interesting.
Right. They're saying, we want you to stay invested and participate in the global upside of what we are about to build together. It is an incredibly powerful signal of confidence in the sheer quality of these Canadian assets.
And those assets instantly reshape the Canadian energy map, right? With the stroke of a pen, Shell becomes Canada's largest condensate producer and the third largest natural gas producer.
Instantly. Yes.
And the sources explicitly state that this acquisition backstops Shell's liquefied natural gas or LNG export strategy. But I kind of have to play the skeptic here for a second.
Go for it.
Shell operates everywhere, from the North Sea to the Gulf of Mexico. They have trading desks spanning the entire globe. Why do they specifically need Canadian assets to backstop an LNG strategy? Don't they already have enough gas?
Well, Shell certainly knows how to move energy around the planet. There's no doubt about that. But the macro picture for LNG is shifting rapidly right now.
Mm-hmm.
So you chill natural gas to a liquid state, put it on a specialized ship, and send it to energy-hungry markets, primarily in Asia. And right now, there are major new export terminals coming online on the west coast of Canada.
Okay, the West Coast.
Right. Geographically, shipping from the Canadian west coast to Asia is just significantly faster and cheaper than routing ships all the way from the U.S. Gulf Coast, through the Panama Canal, or all the way around South America.
Oh, wow. So it is a proximity play. They essentially want the shortest route across the Pacific.
Exactly.
Which is a profound geographical advantage. But, they still need the raw material to put on those ships in the first place.
Right. And to feed those multi-billion-dollar liquefaction facilities for the next 30 years, You need decades of high-quality, uninterrupted inventory. And more importantly, you need incredibly low-cost feed gas to maintain your margins on the global market.
And ARC provides that.
ARC provides exactly that. Plus, the sources really highlight ARC's strong safety culture, their people-first approach, and these deeply established relationships with Indigenous partners and local communities.
Which is huge in Canada.
It's massive. For a global entity like Shell, acquiring an asset that already has an impeccable, proven social license to operate that's almost as valuable as the physical geology itself. You do not want to drop $22 billion on a regulatory headache.
Right. You want to buy a turnkey solution. Which brings us to the physical location of this resource. We're talking about a specific geographical asset that makes ARC so incredibly attractive, and that's the Montney.
Yeah, the Montney. It is arguably one of the most profitable and prolific resource plays in all of North America.
And just for context, it's this vast subterranean geological formation spanning across northern British Columbia and Alberta. Right?
That's the one.
And ARC is an absolute titan in this region. The sources say they hold over 1.1 million acres in the Montney.
A massive footprint.
Yeah. And the investor presentation outlines their key growth areas, places with names like Kakwa, Attachie, Greater Dawson, Sunrise. And the data shows the Montney outcompetes other North American shale plays, like, say, the Permian down in Texas.
Absolutely.
Because of its deep inventory. ARC has over 20 years of drilling runway. But I actually have to stop you right here.
Okay, what's up? Because
I was looking at the supply cost charts in the slide deck. And, well, here's where it gets really interesting. It says approximately 50% of ARC's total inventory has a supply cost below $0 per McFell.
Yes. The infamous sub-zero supply cost.
Wait, less than a free... I mean, you have to explain the math on that to me because it honestly looks like a glaring accounting error. How do you pull a physical resource out of the earth, process it, and have it cost you -$?
I know it sounds literally impossible, but it is actually the central genius of ARC's specific acreage. And this raises a really important question about what is actually coming out of the wellhead. When we say natural gas well, the average person usually pictures just, dry, invisible methane gas blowing out of a pipe.
Right, like what comes out of your stove.
Exactly. But ARC's wells in areas like Kakwa are what the industry calls liquids rich.
So they are pulling up a mixture.
Precisely. Alongside the natural gas, these wells produce just enormous volumes of highly valuable liquid byproducts, specifically things like condensate and natural gas liquids, or NGLs. And condensate is exceptionally valuable in the Canadian market.
Why? Like, what makes it so special there compared to anywhere else?
It all comes down to the Canadian oil sands.
Oh, right.
Yeah, Canada produces a lot of heavy crude oil that is incredibly thick. I mean, it's almost the consistency of peanut butter.
Wow.
So to get that heavy crude to actually flow through a pipeline down to refineries in the United States, you have to thin it out. You have to dilute it. And condensate is the perfect diluent for that.
I see.
So the local demand for condensate is just sky high, and it commands premium pricing. The revenue ARC generates just from selling those liquid byproducts is so substantial that it pays for the entire operational cost of drilling the gas well.
Okay, let me make sure I'm fully grasping this. They drill the well, sell the liquids to the oil sands producers for top dollar, and that completely covers the drilling crew, the equipment, the maintenance, literally everything.
Every single expense, yes. By the time you account for that liquids revenue, your net cost to produce the actual natural gas drops below zero. It is effectively a structural subsidy built right into the geology.
That completely changes the paradigm. So the natural gas they get alongside those liquids is essentially free feed gas.
Exactly.
So Shell just bought a multi-decade supply of free natural gas to load onto their LNG ships.
That's the secret sauce.
But hold on, if the geology is this lucrative, why isn't every other driller in North America doing exactly this? Like, what makes ARC's operations so difficult to replicate?
Well, you can't replicate it, because you can't go back in time 20 years and buy up all the land.
Fair point.
The sources show ARC drilled their very first horizontal well in the Montney way back in 2005. They spent 2 decades meticulously assembling this contiguous acreage.
Contiguous meaning it's all connected.
Right. And having connected land allows for highly efficient, large-scale development using really advanced techniques like dual frac systems.
Wait, before we go further, when you say dual frac systems, what physical mechanism are we actually talking about underground?
Okay, so Traditional fracturing involves drilling one horizontal well and stimulating the rock to release the gas.
Okay.
A dual frac system involves drilling two parallel horizontal wells really close to each other and fracturing them simultaneously.
Wow, at the same time.
Yeah. By doing this, you increase the complexity of the fractures in the rock, which yields way more resource. Plus, you share all the heavy surface equipment, the pumps, the water lines, the sand storage between the two wells.
Oh, that's smart.
Right. You drastically lower your per well surface costs while maximizing your underground extraction.
Okay, so they have incredibly cheap gas because of the liquids, and they extract it hyper efficiently. But producing cheap gas is really only half the battle, right?
Exactly.
Because if you have to pay exorbitant fees to third-party pipeline operators to move that gas across the continent, your sub-zero cost advantage evaporates immediately. So how did ARC avoid that trap?
That is exactly where ARC transitions from being just a lucky exploration company with good geology to being a formidable industrial powerhouse. They built an extensive infrastructure moat.
Right. To visualize this, it's kind of like commuting to work. If everyone in the city tries to use the same public highway at 8 a.m., you get terrible congestion, delays, and wasted fuel.
A nightmare.
Yeah. And in the Canadian gas market, that congested public highway is the AEQ hub, the local Alberta pricing benchmark.
Exactly. AEQ is essentially a landlocked market.
Yeah.
Because pipeline capacity leaving Western Canada is often constrained, producers just get stuck dumping their gas into the local market. And when supply outstrips local demand, the price of AEQ gas just plummets.
So ARC's solution was basically to spend 20 years building their own private express toll lane, completely bypassing the local traffic jam.
They own the toll road.
Yeah, they own and operate an enormous network of their own infrastructure. The sources show they have approximately 2 billion cubic feet per day of natural gas processing capacity and 200,000 barrels per day of liquids handling capacity.
And the financial impact of owning all that steel in the ground is profound. The sources indicate this owned infrastructure results in approximately $300 million of cost avoidance annually.
$300 million.
Every year. They aren't paying a middleman's profit margin to handle their product.
Right.
But if we connect this to the bigger picture, it isn't just about avoiding processing fees.
What else is it about?
It is about dictating exactly where your product goes.
Right. They take the express lane straight to the premium buyers.
Exactly. Around 50% of their natural gas production is delivered directly to the United States, reaching high-demand markets like the Midwest and the U.S. Gulf Coast.
Wow.
Furthermore, about 25% of their future natural gas production is already linked to international pricing through long-term agreements. They essentially isolated themselves from local price crashes.
And we actually have hard proof of how well this works from their Q1 2026 earnings report. Let's look at the pricing.
Let's do it.
Their average realized natural gas price in the first quarter was $4.51 per McF. And McF just being the standard volume measurement of 1,000 cubic feet of gas.
Right.
To put that $4.51 in context, that is a staggering 81% higher than the local AECO benchmark price during that exact same period.
81%.
They're making almost double the money on the exact same molecule of gas simply because they have the physical infrastructure to pipe it to where the demand actually is.
That is the definition of an infrastructure moat. You cannot replicate that overnight. Shell is buying that entire logistics network completely intact. They are avoiding years of regulatory approvals, construction delays, and capital risk.
Which brings us to the timing of this deal. We've established the long-term value of the Montney assets in this incredible infrastructure moat. But the day after the Shell acquisition was announced, ARC released their Q1 2026 earnings report.
Yeah, talk about a mic drop.
Honestly, yeah. It is an absolute clinic in operational efficiency. It proves the system is currently running at peak performance. But I have to ask a cynical question here.
Okay.
Did ARC deliberately polish the company just to sell it? Like, did they run the engines in the red, drive up production, and dress up the financials to fetch this $22 billion price tag?
You know, it is really tempting to view it as a perfectly timed exit strategy, but the Q1 data actually points to a very different reality. You can't artificially fake the kind of structural efficiency we are seeing in these numbers.
Okay, let's look at the numbers.
Let's look at the production scale first. They hit a record first quarter average production of 418,522 BOE per day.
And just to clarify for the listener, BOE stands for barrels of oil equivalent. It's just the industry's way of combining the varying outputs of natural gas, condensate, and crude oil into one standardized scorecard so we can measure total energy output.
Right.
But over 400,000 BO per day is an immense scale.
It's massive. It is up 12% year over year.
Yeah.
But here is the metric that proves they weren't just blindly pumping gas to inflate top-line numbers.
What's that?
Free funds flow. ARC generated $459 million of free funds flow in a single quarter.
Wow.
This wasn't a grow-at-all-costs strategy, It was highly profitable growth. They even returned $256 million directly to shareholders through dividends and share repurchases in Q1.
Okay, so returning capital proves they were cash rich. But what about their expenses? I mean, if production goes up 12%, surely the logistical cost is moving all that extra product went up too, right?
See, this is where their strategy really shines. Despite record production, their transportation expenses actually decreased by 10% per bow year over year.
Wait, how is that physically possible? How do you move more product but spend less doing it?
Because they weren't just sitting still waiting for Shell's offer. In February 2026, right in the middle of this exact quarter, ARC completed a $164 million acquisition of adjacent assets in the Kakwa area.
Oh, I saw that in the notes.
Yeah, and crucially, that deal didn't just add land. It included a 50 million cubic feet per day gas processing plant.
Ah, so they brought the processing capability directly to the wellhead.
Exactly. See, when you extract natural gas, it comes up wet. It's mixed with water and impurities. If you don't have a processing plant nearby, you have to pay trucks or third-party pipelines to move that heavy, untreated mixture across the province just to get it cleaned.
Which is incredibly expensive.
Right. By acquiring a plant adjacent to their new wells, they strip the water and impurities immediately on site. They eliminate the need to transport useless weight, driving their per-unit transportation cost down by 10%.
So what does this all mean for the Shell deal?
It means Shell didn't buy a distressed asset that needed fixing, and they didn't buy a company that was artificially inflated for a quick flip. ARC operates on a highly disciplined framework focused entirely on, quote, free funds flow per share growth.
Right.
They have a balance sheet first mentality. Look at their 2026 capital budget. It remained completely unchanged at roughly $1.8 billion despite the acquisition news.
That's discipline.
They had a clear line of sight to grow free cash flow by 80% out to 2029, completely on their own. Shell paid a premium because ARC was operating a 100-year business model flawlessly today.
That context really ties the whole narrative together. I mean, Shell's $22 billion acquisition of ARC Resources is just a masterclass in strategic integration.
It really is.
It isn't just about buying land in Western Canada. It is about acquiring a highly efficient, cash-generating machine. Between the sub-zero supply costs unlocked by the liquids-rich Montney geology, the $300 million in annual infrastructure savings, and the premium market access that allows them to completely bypass local pricing bottlenecks, ARC just built an absolute masterpiece of an operation.
A masterpiece that Shell needed.
Exactly. It was exactly the masterpiece Shell needed to feed its global LNG export strategy.
It fundamentally redefines what a premium asset means in the modern energy landscape.
Right.
It is no longer just about the raw volume of the resource,
Right.
It is about the extraction cost, the logistical control, the global market access, and the established community trust. All of that meticulously bundled into one entity.
Which leaves us with a final thought to ponder as we wrap up this deep dive. We are watching global supermajors like Shell increasingly buy up these highly optimized, heavily infrastructuralized producers like ARC to secure their worldwide supply chain.
It's a clear trend.
So what happens to the remaining independent producers? If the entry fee to compete globally requires owning your own processing plants, building private pipeline networks, and achieving sub-zero supply costs, will the future of North American energy be entirely dominated by a handful of integrated global players?
That's the big question.
Are we effectively witnessing the twilight of the nimble, pure-play independent producer?
I mean, it is a structural evolution that will dictate market dynamics for decades. The independent companies that are only building partial solutions, they're getting left behind.
Yeah.
While the companies that built fully integrated ecosystems are just being absorbed by supermajors.
Wow. Well, thank you for joining us on this deep dive. You are now fully caught up on the mechanics, the strategic logic, and the sheer operational scale behind one of the most significant energy acquisitions of the year. Keep questioning the headlines, keep exploring the deeper mechanics of the market, and we will see you next time.